Yeah.
I feel like it wasn't that long ago I saw you with like luxurious locks, but that probably
I,
was a long time ago.
it's like this is my modus operandi. Like no one knows me every time they see me.
There's two groups of people in this pandemic. It's the let it grow and forget about it, or the shaved head.
And forget about it.
Yeah.
I thought about shaving. This is like 4.5 years worth of hair growing here, but
A
it would
lot of
sure be simpler and easier.
I think that, I'm going to chat a Google Doc that I'm going to be taking notes in, and maybe just wait uh, another minute, and we'll get started. I
All
was
right.
really hoping Nick Schwar would be here, but I think he's on vacation. So while we're waiting, Andrew, just to kind of catch you up, welcome to Penny University. That's what you're seeing right now.
Okay.
We are a group of social learners. It's just kind of the group that I've been working on for a couple of years. And the idea is like, we get to get together with other people who are interested in just sharing ideas. And a lot of people were asking about startups and how startups get funded. So I invited you and Holroyd here just as kind of a soundboard. So no prep or anything. And since we got several people here, why don't we just get going with it and see what you think? Maybe a quick round of introductions. Andrew, you want to go first?
Sure. So my name's Andrew Montalenti. I'm one of the two co-founders of a SaaS company called Parsley. That's spelled parse.ly. And basically, I'm the technical co-founder of the company. I'm currently the chief product officer. I was originally the company's CTO up until a few months ago. And I guess we got started sort of during the last big recession. So we sort of started getting bitten by the startup bug back in 2008, 2009, when there was the financial crisis that seems relatively tame by comparison to today. And we sort of went out and worked on startup ideas, my co-founder and I, from 2008 to 2009, and then bootstrapped a startup idea for about 18 months, and then ultimately took seed financing in 2010 and kind of went down the venture path with our current company after then. So that's the background for me.
Were those two different companies, or was it always Parsley, or was it a different?
It was a pre-Parsley. My co-founder and I took the concept of we were going to work on a idea together, so we knew who the two co-founders were, and we had an idea for the original product, but we decided intentionally to pick a really bad original company name because we knew that upfront it would be hard to get the name right. So we picked a bad name and worked together under that name for a couple of years before finally picking Parsley as a name and then putting that on the company. So when I describe the 2008 to 2009 period, it's pre-Parsley, but has a spiritual connection to Parsley, I guess. So, yeah.
Interesting. Michael, do you want to introduce yourself? And then we'll
Yeah, sure. So I'm Michael Holroyd. I guess I founded 3 companies in kind of different ways, which might be something interesting to the group. So I did a PhD in computer science, and right after that, I founded a company sort of based on my research that was entirely bootstrapped, but it was bootstrapped basically through like a combination of like early customers, but also government grants. Which was super helpful. And that was like 2011. And then at some point after that, I started a company which also went through a couple of names, although our intention wasn't for the first name to be terrible. I have to say, I like your strategy, Andrew. All my company names have always been terrible. And we've never done
the whole thing is that you always come up with the name before the company, right? So if you can just pick a bad name first that you're forced to change, you won't feel connected to it.
I need to pick that tip for the next thing. But anyway, my current startup is called SceneThink, which if you think about it, you'll spell it correctly. And that was maybe, I don't know, that was like 2 years ago. And that was, I mean, it was bootstrapped in the sense that we did have like, maybe up of somewhere like 10 customers. But this most recent startup, instead of bootstrapping, we did sort of seed round, angel round to get the company started. And I'm the similar to Andrew, sort of technical co-founder at three of those.
And I guess Holroyd, you've also been involved in the fundraising process too, right? So I guess for Scene Think, there's
Yeah, I tried as hard as I could to stay out of the fundraising process, but I begrudgingly was somewhat involved with the Scene Think fundraising.
Gotcha.
The rest of the guys do you guys want to do a quick intro, just kind of your interest in the topic for today? That'll help channel some of the questions. How about George go first?
My name's George. I've done a couple of businesses like you, Michael and Andrew. Nationally distributed jerky company, did an aquaculture nutrition company, and now I'm working on a software business. Thanks, and happy to be here.
Peter?
Hi, I'm Peter. I work for a company called Gust. Started as technical co-founder and am now essentially running the business. So I come to this as a technical person who's thought about starting a business, but has always been intimidated by the legal underpinnings and the financing underpinnings. I'm now working on a product that helps to fix that in Gust Launch. So I'm here both to get personal perspective and also product perspective.
Nick?
Hey, I'm Nick. Right now I'm working full-time for a company called Watershed, but kind of been bitten by the startup bug and just interested in gathering some knowledge and learning more about people's experiences with funding and kind of what Peter said, just the legal knowledge and some of the more meatier stuff.
Full disclosure, Nick is my partner in crime with Penny University. We want to make it a real boy someday. Max, you gonna
go? Sure. I'm Max. I just left my job 2 months ago to work full-time on something that I've been thinking about for years. It's a way to save companies that are running Kubernetes a lot of money. And the long-term vision is to, whenever you have something going on in the cloud, switch the model instead of you being locked in to having various cloud companies be able to bid. And so there's a long way to that, but I've been working on it myself. I'm looking for a non-technical co-founder, and so I'm really curious about funding and that road in general.
I remember, Max, your really pithy pitch was service as a service as a service.
Yes, small pivot from there. I realized that telling companies that, hey, change the way you do everything real quick, it's going to be great, I promise, is a really hard pill to swallow for them. Yeah. So there's a tiny piece of it where you can drop it in place, it's transparent to all your tooling, and it just automatically saves money.
Cool. Well, let's dig into the topic of the day and just get a little bit more detail. We've heard intros from everyone, but Andrew and Michael, how should we start thinking about funding our startup? Assume, for me, for example, I know next to nothing about it. Should I ask my aunt for some money? Should I start fishing around for seed funding, or should I start connecting with venture capitalists? Make my question make sense, and then answer.
We can do that for you, John. I guess either of us could take this. I don't know.
Yeah, I full disclosure, like,
or both. Yeah.
I consider like Andrew like sort of a mentor of mine when it comes to this topic. So pretty much anything Andrew says, I'm gonna like nod my head and give a thumbs up. So yeah,
y'all in that case, y'all are screwed. But no. Actually, before I get into that really quick, just a quick thing for me. So Peter, who introduced yourself, you said you're at Gust. Is that the same Gust that is like the David Rose founded company?
It is.
Yeah. Okay, cool. It's just a funny connection because back in my early days as a New York City tech entrepreneur, I pitched David Rose on Parsley way back when. So anyway,
so touch base and see how many words you got in.
Yeah, exactly. Okay. So, I mean, I guess let's start with the basic question that John had that I'll try to make sense, which is, there's a lot of different paths to financing, right? So you can, there certainly are companies out there that have gotten started out of founders' life savings. There's companies that have gotten started out of credit card debt that the founders take on. I've heard of refinancing your house and pulling out money from there. And then of course, particularly well-off founders or people who come from rich communities or rich families will do what we used to call your rich in-law giving you a lot of money, but now people call friends and family rounds. So in order to make that sound better. And I'm not going to be able to give you any perspective on any of those above options because my co-founder and I met at college at NYU, and we're both the children of immigrants. And like, we don't have rich family connections who could like have bankrolled us. And we also, especially in our early 20s, didn't have any rich friends or any like network into, the world of people who can write a $30,000 check the way maybe you or I puts a $1 bill into a Coke machine, right? So like, that's kind of not a world I was exposed to. So for us, it was also really important that we didn't do anything too personally catastrophic either. So like, we didn't, I think my co-founder and I did sort of put our early 20s life savings into the business, but we did it in a way where like, it wasn't all or nothing. We sort of put our life savings into a consulting business first to try to like make ends meet outside of a full-time job. And then later put some money into a business that we bootstrapped that started to try to earn revenue before we asked for venture investing. And like, my kind of advice to new founders is like, don't, especially today in 2020 or whatever, don't financially endanger yourself as a first resort, because there actually is a lot of seed and angel capital out there in the world. This was like a little bit less true back in 2008, 2009, but it's like much truer today. Like, there's just a lot of angel money and sort of early stage money floating around. So my first piece of advice is like, don't do the credit card debt thing. Don't do the life savings thing. Don't mortgage your house, but at the same time, my other piece of advice is don't necessarily raise money from investors right away either, right? So if you can find out some way to either, do two things at once, like sort of like quit your job and work on consulting and free up some of your time and work on your business, or like some way to make your business make money sooner, which is actually more possible today than it used to be, with like the ease of collecting payments online and like the comfort with people buying software online, I would recommend that you try to like sort of give a shot to bootstrapping a company first, right? And the reason for that is that investors, even though there are a lot of them out there, and there are a lot of like angel investors out there who would like gladly bankroll your business, if you're a first-time founder with an unproven product idea that has no traction, you have no leverage in your angel investing and seed investing environment. And that means that you will, by definition, get a low valuation placed on your business, at least if you're talking to smart money. And that will then kind of screw you over later. It'll basically make it harder for you to properly capitalize your business if it were to succeed. So my first piece of advice is like, don't endanger yourself because there is capital out there. But on the other hand, try to prove something about your business first. Try to like get excited about an area and start to get something. It doesn't have to be revenue, but try to get something that represents traction, right, for your product before you go out and raise. But then at that point, once you have a little traction and you have a little pitch, I would say there is angel capital out there that will fund you at appropriate terms. So you should go after that and not like friends and family and stuff. Unless you just have like a rich uncle who will like wire you 100K, in which case, sure, take that money, I guess, if he doesn't care about it. But don't do it out of necessity, right? There's smart money out there that's willing to play the seed game, is my advice.
Can you sorry, no, go ahead, Michael.
Yeah, I guess just to follow up on that, I think you touched on exactly the things I think are the most important. And the first one is like, of course, it would be great to bootstrap your business, right? Everyone wants to own 100% of their business. And it depends on the type of business you're talking about, whether that's really feasible,
True.
If you're doing
if you're doing a deep research project, you're trying to develop the next SpaceX, rocket booster, you're not going to be able to do
exactly.
that.
Really, especially anything that just requires a physical product, even if you're a 80% software company, but you're doing some IoT widget, that's just a different world. Than I think probably all of us here are sort of in like the software space, and it's
I think my advice, generally speaking, only really applies to software companies, because I think my kind of assumption for what is stopping you from working on a software company, if you are so enabled to do so, is like, I don't have a team. I don't have the money to hire people who are good, because good people work at other companies where they get appropriate salaries, and I can't afford an appropriate salary, right? And then the other thing is, you might say, I don't have like an idea or a passion or a mission or a vision, or like what the thing is that I need to be really working on. And those are really the roadblocks for software companies, right? Then, as Michael is pointing out, there's all sorts of other roadblocks if it's not a software company, like physical products or manufacturing or research or whoever, whatever you might come up with. But for software companies, it's like pretty much at your bootstrapping period, and then even as you get to scale, your primary cost is going to be payroll, and your primary true cost is going to be opportunity cost, right? So it's like, your true cost is like, what else could I be doing with my like software skills instead of this, right? And that's kind of true for your whole team too, right? So the whole reason to finance your business, once it starts to get traction, is like, well, now I can start hiring real engineers, and I can start hiring like real salespeople, and we can like really grow this thing, and it can be like a real going concern instead of like a fly-by-night operation that might disappear next week, right? Which no one wants to really join. So yeah.
Okay, so I kind of have two questions. The first is around kind of, what are some of the metrics, or I guess some of the momentum that you might be looking for when you transition from bootstrapping to actually looking for funding? And then, yeah, actually, let's just start with that one. What do you look for to decide when you can actually make that transition?
So this is like a moving target through the years, unfortunately. So there isn't like a really clear answer I can give you to say like, oh, it's exactly this metric for this kind of business or something like that. The way to better think about the problem, in my opinion, and then I'll hear what Michael has to say on this, is like, think of venture capitalists and angel investors as like really poorly trained machine learning models that try to detect like high growth potential startups. And they do that over time using all the knowledge of their fellow peers in the venture capital community and all the meetings they have with entrepreneurs over the years. So what that means is that the model keeps updating as they talk to more entrepreneurs and see more trends and read more TechCrunch articles and whatever else. And so what they're looking for, like if you had said this to me in 2008, there were a lot of VCs who were looking for the next Facebook, right? Because they were sort of like, viral growth is amazing and social this and that is amazing, and I want to look for a company that looks like a social something or other. And like a lot of VCs, I think actually even David Rose, one of the people in New York, funded, for example, Pinterest in that period, because they were like, Pinterest looks like Facebook but for like a different audience. And then they turned out to be right on that, and people were funding, of course, like the Instagrams and stuff in the world. But that was like a category of investors. But if you ask investors now, is anyone looking for the next Facebook? No, not really. The machine learning model has kind of like, all of those examples have already exited, and now there's like no more upstarts that seem to be doing the social thing. So the VCs like don't really care about social networks anymore. They kind of think that that market is over, right? And so you just have to imagine that that's going on all the time. So they're very much like trend following. There was, I'll tell you a funny example right now, which is actually, this is really funny with Michael on the call. So there was a category of VCs that were obsessed with augmented reality and VR for the last few years. And then COVID happened and the category ended up sucking in COVID, like it didn't work. Like AR and VR didn't suddenly take off even though we were all trapped at home. So now a bunch of VCs have like written off that category, right? Because they're basically like, well, this was the ultimate test. If COVID happened and AR, VR didn't like explode onto the scene, it's never going to explode on the scene. By the way, they might be wrong about that, but like that's the way they operate, is like they kind of look at the short-term data. They try to figure out, okay, where are the high growth potential companies, and what are like going to pattern match as not high growth potential, you know? So then from the metric standpoint, like to Nick's question, you know, there's actually a big group of investors right now that are looking for seed stage SaaS companies. And they do have a lot of metrics for how they evaluate SaaS companies, because there's still a lot of momentum around SaaS. It's like the public markets has great enterprise SaaS companies. There's a lot of great ones growing up right now. And their feeling is like, oh, I have to get at the ground floor of some other SaaS company that's figured something out right here. So you'll see a lot there. On the consumer side, I'm not as in touch with it anymore, but like, you know, for example, kind of a stupid one right now is on the consumer side, a lot of investors are really excited about video because we're all trapped at home. They think this is like the video era finally, right? So a lot of consumer things that have a little audio video twist are now getting a second look with VCs, right? And
I'm recording this, by the way.
Yeah, there you go.
We're hitting you live. Welcome. Go
yeah,
on.
so my kind of perspective is like, it's unfortunately the case that you have to study the way the VCs are kind of operating in order to be able to get funded by them a little bit. On the other hand, though, some VCs will tell you like they don't want founders studying how they're operating because that messes with like the objectivity of their machine learning model chasing the trends or whatever. But there is definitely a little bit of that, and that then drives the metrics. So, you know, if they see a startup right now, to give you an example, that's like video enabled and it grew really gangbusters during the COVID crisis, and they just haven't monetized it yet because they haven't figured out how, but they have a ton of users and people are using it for some useful purpose, and they can use it and they can see that it does something useful, that company's probably going to get funded right now, right? Even though it might have zero revenue, might have seed capital or be bootstrapped or whatever, there's just like a lot of interest in that right now, so it will get funded, right? That's kind of something that you have to be aware of.
Yeah, I think so. Like one of the side effects I think of there being a lot of angel and sort of independent investors, right? And I don't know if everyone knows the terminology, right? But sort of a VC is like, I have piled together a bunch of other people's money and I'm in charge of it. It's not really my money, but I'm in charge of investing it. And, you know, an angel investor or a seed round investor is typically, you know, someone who's independently wealthy, they're investing their own money. And I guess something I'd add is like, while VC firms are, you know, typically fairly sophisticated and they sort of know what they're looking for and they know how to analyze it, a lot of smaller investors, you know, it's really just all comes down to if their personal passion sort of aligns with what you're doing. And so I think there's more.
There's also a lot of angels who back founders very specifically. Like,
yeah,
they like the people. They think this will be a fun ride with this pair of founders or whatever.
Yeah,
let's see where.
Especially when you're a first-time founder, you're relying on that connection, right? Because I mean, you don't have a portfolio to show that you know what you're doing and you're successful at that. You know, you asked more specifically about kind of like the metrics. When does it make sense to raise money? I do think it's important to have a story for like, why am I raising money now? And it's not necessarily like, oh, I think I've shown enough traction that I can convince someone to give me money now. It tends to be something of the flavor of like, I had this idea for a business. I made this MVP and look, it's working. If I only had $1 million, I could X. And like, that's kind of the format that you want that to take. And, you know, and you know, people are going to inspect that, right? Like, you do need some metrics to show like, no, it's not just my gut check. It's like, I have these customers who are showing up faster than I can serve them because I don't have a customer support team, or like, every time I do this, I make twice as much money, but I can only do it in $100 increments because I'm poor, you know, give me more money. Like, to me, those are the things that really resonate. And again, with the exception of, you know, sometimes you have an investor who's just very passionate about like, education, for example. If you're doing education technology, sometimes you don't need to show that. Sometimes it's like, hey, keep this thing afloat for another 3 or 4 years because we're helping kids in South America go to college. Like that's also a different category. So, and that's just one example, but I think there's a lot of examples of that now. If you can connect with someone really in your space who is an investor, sometimes those rules about growth and metrics don't apply. So
yeah, Michael's raising a really good point, which is basically what is the investor's incentive in funding you? And a lot of times we think from the entrepreneur angle, we're thinking to ourselves, I want this idea to exist in the world. I want to be my own boss. I want to start this company. I want to hire great people. Like, what am I trying to get out of investment, right? But you have to think to yourself, what is the investor trying to get out of it? And if they're an angel, as Michael said, it's usually their own wealth, which means that probably what they're trying to get out of it is a connection with the founders that kind of gives them a glimpse into the future, is kind of the way they think about it. And then also, it'd be nice if it returns some money to me. But again, I'm a wealthy guy or gal, so I don't really care if it returns that much. But like, sure, I'd love to be able to brag to my friends that I wrote the 100K seed check into Pinterest and it got turned into like hundreds of millions of dollars later, right?
Yeah. And I have to say, Andrew, you mentioned like, if they're smart money, there's a lot of dumb money out there.
There's a lot of dumb money out there.
I have to say, some of our founders will self-identify as like gentlemen farmers who just don't know what to do with all this money. And like, for them, it's part of being in the social club, right? I don't even know if they read our reports, but it's like they get to go hang out with the other, 20 people who all co-invested with them and talk about their lives that we can't relate to. So
yeah. Yeah, so there's a kind of a aspect to angel investing among the wealthy set that is kind of akin to art patronage in a way, right? So think of it that way. And then from everyone up, so that Michael covered venture capitalists, or he talked about them very briefly, who manage other people's money. There's actually an in-between, which is known as family offices, which are they typically invest their money in a more sophisticated way in venture funds, but increasingly in the last few years, they directly invest to just cut out the venture capitalist middleman and like avoid having to pay fees to venture capitalists for their investments. And so there's like a kind of curve of sophistication. So as you go from angel to family office to venture, and even, by the way, as you go from seed stage venture to later stage venture, the asymptote of those venture capitalists starts to approach Fortune 500 Wall Street firms, right? So it's like, as you get further down in the funding cycle, the kinds of people you talk to feel more like just traditional investment bankers at Goldman Sachs or whatever, right? But it's kind of they're more low key, or I guess more nimble as they go lower, closer to the family office, right? And so what is that latter set getting out of investing in you? And the answer in that case, once you go past angels, very much is return on investment, straight up financial return. And the mental model that you need to think about is that they want to be the check that got written into your company, that if that check hadn't been written into your company, you would have just fizzled and died. But because the check was written into your company, it started at value X and the value was 10X within 18 months. So whatever the value of your company was that they wrote the check, they want the company to be worth 10 times more in 18 months because of their check, right? Now that's all paper gains, usually, unless they get lucky, right? So usually it's like the value's going up for some other investor. And that's when, venture capital starts to resemble a Ponzi scheme a little bit, which you can research. But like, as you go up and to the right in that valuation curve, you also start to open up the possibility that the company can exit being, be sold to another acquirer, IPO, and so on. That probability, although low, starts to go up as you move up the right-hand curve. And a final exit with your company at some date into the future, they want to see that was like 10X within 18 months of every investment. So that means that like if your seed writes an investment today, in 2022, they want to get 10X their return, and whoever you get to fund you in 2022 better value you at 10X of the seed, and then they better get a 10X on that, right? And so in that way, your company moves up in value, kind of riding the the venture capital, accelerant, or using their capital to accelerate your business, basically. But that's kind of what they're looking for. And when Michael describes the story, you might not have to be able to articulate that perfectly well. They aren't expecting you to be sort of a cold-blooded capitalist the way they are. They kind of want to see like the sort of tingle, the sparkle in your eye about excitement for the idea. And almost they kind of like it better if you don't know how much it's worth, because then they can kind of screw you over a little bit. But like you need to show them that it's like really exciting and it's going to grow. And yeah, it probably will somehow in some model be worth 10x more later on. And you have to kind of make them aware of that somehow through your story.
So I got lots of questions following all that. I guess they go in a ladder, but both of you, your experience when you did this for the first time, where did you go? How did you get that first meeting? How did you kind of educate yourself on, okay, this is actually what I need to bring to convince angels. This is what I need to bring to convince this next set. And then also, how far up that ladder have you gotten, and what has life looked like at each inflection point? Do you wish you'd done something different? Going from angel to VC really does shift that primary motivation to return. And did that negatively impact you ever?
Yeah, I guess I could go first. For us, as we were bootstrapping Scene Think, it just kind of came apparent to us that it wasn't going to be a fast process. It was like there's just two of us. The Scene Think sells into sort of like larger media companies. They're kind of slow moving machines, and we really did have a choice, I have to say. I mean, we definitely sat down and we're like, okay, like this is what this would look like if we bootstrapped. This is what it would look like if we raised like 700K. This is what it would look like if we raised like 2 million. And, we basically decided that it was the kind of project we would rather do quickly and possibly screw up and flush down the toilet, which is not always the case, right? I mean, sometimes your company is like really the thing you're super passionate about. In this case, it was really like an opportunity that had kind of landed in our lap. And we were like, we can clearly knock this out of the park if we just focus on it. So it was really to get that focus and to get some money to like accelerate it. I have to say, everyone, all the reading you do, of course, will tell you this process is like more painful and takes longer than you think. For us, I knew that, so it was even worse, right? So for me, it was 4x longer than I thought, and like 4x worse than I thought. And most of that is just around, you have to talk to a lot of people, and the best feedback you can get is sort of those early investors who say no, is kind of like digging in a little deeper and kind of grilling them on what their mindset is. And again, it's not that all investors are the same, but if you're screwing something up in your pitch, they'll let you know one way or the other usually. But the other thing that happens is people will drag you along, right? Like nobody wants to be the first big investor. So the first thing we did is we basically like really, we were kind of lucky in that sense. We pitched a few people. We found one person who was like, I'll be the lead investor in this. I'll put in 500K for your like 1 million round. And like, let's do it that way. And so we had that lead investor, but it's like everyone else is waiting to see if like other serious people get on board, right? It's like, no one wants to be the bozo who got in first on something that doesn't work, especially when it's this kind of like dumb money, right? They want someone they know is smarter than them to put in a lot of money. Then they can say like, oh, well, so-and-so was doing it. Like, I don't know, it seemed cool. I didn't pay much attention. So anyway, after that, yeah, it's just like pitching a ton of times, and our pitch definitely changed, over the course of, I want to say that was like 4 to 6 months before the round closed. We did something weird. We did one of these rolling closes where like, basically once we had 700K, we were like, right, give us the check. We're going to start spending this money while we also fundraise. I don't know if I would recommend that to people, because now you have your focus split. That last 300K took fucking eternity to get. We eventually turned it into a 1.5 million round because it just like made more sense because we had already spent so much money, and having a moving target like that, I don't think is great. On the other hand, we needed some money. So that's what we did. So that's as far as we've gone. We have not, we haven't done a second round. We basically we should be pitching right now. And for us, we're in like the events industry and COVID sucks. And yeah, I just,
Not a good time to pitch.
not a good time to be fundraising. So we're sort of doing some strategies to stretch it out, hoping to get basically to like July of 2021. And doesn't look like it's going to be any fucking different then, but hey, who knows? We'll see.
Yeah. Yeah, the thing Michael brought up on rolling closes is just like a point of debate in the founder community. It's like some people think they're good, some people think they're bad. People are very passionate about this. The difference, by the way, just in case it isn't clear to everyone, is like in one model, there's a date, that's the closing date, and the whole round closes that date. Every signature, every check comes in by that date, and then it's just done. In the rolling close model, you sort of have a first closing date and then several other closing dates, and people can kind of come in late. There can be like stragglers who come in, new people can come into the round. So it's a little bit more complex, but it also is more flexible if you want to get money faster, because you can't really settle on who your full set of investors is for a closing date, right? So there's arguments on both sides. Yeah, I guess to summarize like what our experience was, I guess I have like probably almost like too much experience at this for like a SaaS company. So what I mean by that is like we were bootstrapped from 2009 to 2010. And that was after doing a seed accelerator program where we actually learned a little bit about how to do startup business stuff, and where we got $20,000 of like, it's kind of like the equivalent of MBAs getting business school competition money. We got like $20,000 in seed accelerator money, which made it possible for us to like sort of play with some stuff, but it's not nearly enough to hire a full-time person yet or anything like that, right? So we did that and bootstrapped afterwards, and we did the bootstrapping thing for like 18 to 20, almost 24 months, 18 to 24 months. And then we did a seed round back in 2010, end of 2010, which was a 800K seed round, which back then that was actually considered kind of a big seed round, but like today, a lot of people do like $1 to $2 million seed rounds pretty regularly. So, but that's kind of also just an aspect of this changing venture environment. And then we actually made our seed money last a long time. So after raising that seed round, we didn't raise a Series A until late 2013. And at that moment, in late 2013, we raised a $5.5 million Series A, which again, kind of weirdly, it's kind of strange. It's like our seed round was bigger than the typical seed round was, but small by modern standards. By the time we got to the A stage, the A we raised was actually viewed as being a little small, right? Only raising 5 million at a Series A stage was viewed as a little small. And, but to us, it seemed very big because it was like, more than 5 times bigger than our seed round, and $5 million showed up in the bank account one day when the round closed. And, we felt like we could really build up a sales team and really commercialize our product. At that point, pretty much prior to the A, almost all of our venture investment and our revenue had gone into R&D and product, and we had very few business side people, right? So we felt like we were sort of commercializing the product with the Series A, whereas we had proved traction with the seed, right? And then we made the A last a long time too. So the A we didn't raise a Series B until late 2017. And actually we raised a $6.8 million Series B, which is undeniably small for a B round. And we chose to do that as like the typical B round would be maybe like a $20 million round, right? But we raised 6.8 million, and we kind of chose to do that because we happened to hit this combination of like our SaaS company had become profitable, and we saw a path to make it grow on top of that profitability pretty straightforwardly. And we happened to find a group of investors to back us in the B who didn't care about taking control of the company. And usually at Series B stage, you have to give up control or you're pretty damn close to giving up control of your company. But in our case, we managed to thread the needle where we could keep founder control and bring on investors and finance the business's continued growth on top of a profitable foundation, which is extremely rare at the B stage to happen. And we did it in lieu of doing a bigger round, which we considered doing. We considered doing like a $20 million B or even upwards of $40 million in the B, but we chose not to and did a smaller round. And then that was our
a little more about what people are giving up when they do it too. Like, just since we're short on time, I would just say briefly that like at the seed round, you know, again, especially if it's angel investors, they're not super sophisticated. They might take a seat on your board if they have to, but they don't really want to, right? They're along for the ride. What you really give up at the seed round is like, now you're a real fucking business, right? You got to like file your shit on time. Like there's a bunch of mandated government bullshit you're going to have to do. And, you know, I think now that's not so
seed
bad.
Is where your corporation gets cleaned up and it becomes like, you're now an investment instead of a company. Right.
Yeah,
so it's like you're a corporation with shareholders. You have to get return to those shareholders and like you've got stock option plans and all that stuff.
Yeah.
And now you're like an investment.
Two of you, it's kind of a pain in the ass. I mean, it is actually a non-trivial amount of work that you've added. And then Andrew, you can probably speak more to like, the stage at which people get board seats and argue.
Yeah. So typically if you're doing well at your fundraising job, you won't give up too much control in your Series A. Your Series A will be your first kind of big multi-million-dollar round typically. Can be as much, I've seen these days A rounds that are ranging up to like 10, $15 million even, right? But it's your big round where you're going to bring in an institutional investor. You're going to have a proper board. They're going to take a board seat probably, but you're not going to lose control of your company yet. You're not like run by the investors. You're basically getting your first institutional money to really prove that this company is going to be a winner. Right. And then every round after that, you as a founder have to come to terms with the fact that unless you are literally the top company in the entire portfolio universe of VCs, you are not going to be able to negotiate for like the kinds of things you see, you know, at the Facebooks of the world, like super voting shares and stuff like that help prevent you from losing control of your company. Whether on paper or in practice. Instead, the traditional venture funded company, once it gets to the B stage, it is a multi-stakeholder business with many investors involved, each with a slice of the pie, each with board seats or some level of board control. And they are essentially your bosses now, right? And like they can fire you. It's not your company anymore. You might have shares that you can secure through legal proceedings and make sure your shares are at least protected to some degree. But it's not really your baby anymore once it gets to the B stage, typically, right? It's now like a vehicle to kind of go on. Despite what you might read in the press, where like a lot of times they want the founders still very involved. So they incentivize the founders to stay, but they're not. There have been a lot of very successful post-Series B companies that IPO where the founder has just like 2 or 3% of the company at that point, right? And they've like financed the rest of it away. Now, truly the best companies don't end up that way. You know, you see the absolute best top decile companies still have 20, 30% founder stakes at the end when they IPO, but that's like, you have to do way better than typical in the venture game to be able to do that. So, yeah.
So it is 15 after, and I don't want to obligate you to get to more time than I said. I guess thank you very much for your time. And any final remarks from Andrew or Michael?
No, I think that's in what you can fit in 45 minutes. I think that was a good little circumnavigation of the space. I'm happy to hang out for a bit and answer other questions, etc.
Yeah, I can answer any other questions. I've got a few more minutes too.
Then I will stick around for 15 more minutes.
Unless no one has questions, in which case.
He does this sometimes.
the earlier rounds, how much or what do you, huh?
Sorry, you
Sorry,
were
I
just
think my
saying in
connection's
earlier
kind of
rounds?
bad.
Yeah, go ahead.
Okay. So in the earlier rounds, say when you're doing an angel or seed investing or investment, what or what are you giving up as far as like percentage in the company or yeah, just in general? What do kind of the terms?
Yeah, like what are the terms of a seed round that's standard, I think is what he's getting at. Yeah. I mean, my advice on this is like, don't give up a board seat unless you really have to in the seed round. And definitely don't sell more than 40% of your company. Probably try to trend it down toward only selling 10 to 20% of your company in the seed. Usually, the seed by definition is your lowest valuation, assuming you don't really fuck it up as a company, right? So like that should be like the floor. And so people should be just sort of along for the ride in the seed round. They shouldn't really be looking to take control of your company. It's actually an anti-pattern if you see a venture investor coming into your seed and being like, I want 50, like what you see on Shark Tank, for example. It's like, I want 51% of your company for like $100,000. It's like, absolutely not. That just is the dumbest investment on the planet because it just ruins your company on the moment that the deal closes. You'll never be able to finance it again because every future investor will be like, why did that guy get half your company for 100K? Like, I want that deal, right? And then basically you won't have any room in your cap table to bring in new investors. So it's kind of like self-defeating to take on terrible rounds like that. You really want, like, ideally a beautiful seed round, perfect seed round is, 10% of the company, let's say it's let's say you do a really small seed round, right? 100K, 10%, $1 million valuation, common stock only, no board seat. That's a great seed investment, right? If you like have low confidence in yourself, but you need the money, go do that, right? And then you can get that valuation up higher with higher levels of confidence and a better story. But still, that just means raise a little more money, but still try to like give up as close to 10% as possible and as little control as possible, kind of.
Yeah, what I see as 20% is a pretty typical number. And also remember, almost all those seed investors are thinking they want to follow on the next round. So for them, it's like 20% is kind of a sweet spot where if they can keep following on and keep kind of 20%, then really any exit that it doesn't suck at that point is kind of a win for them. Whereas like, yeah, like you can talk about 10%, but like, people don't want like 5% of your company.
Exactly.
Right? It's not enough.
And if they're asking for 40%, they're just not they're
so
actually counterintuitively, they are dumb money who are so bad at the game that they will probably never have a good exit. Right. So
yeah. Interesting. How do we bootstrap for longer?
What's that, sorry?
What are some strategies for bootstrapping for longer? Andrew, you stretched your money a long way.
You kind of said it, Andrew, but I mean, I think a lot of people start with the idea of a product company. If you've been in it enough that you have a niche and you can kind of provide like consulting or services, that's an awesome way to get cash from your customers. So you're like still kind of in the right space. You're still learning what you need to know, but you can, fund the company off that if you're in that kind of spot.
I saw a company that did this really well recently with a founder kind of that I got to meet a couple of times. So there's a company called Fishtown Analytics that is behind the open source product DBT. And they basically for like 2 or 3 years without much external financing at all, they just did consulting on people's like cloud SQL analytics warehouses. And they just had like a consulting company where they did that and they like learned a lot of problems that these companies had and they got revenue that let them pay for some talent. And then they carved out time to work on this open source product DBT on the side that then they built like a commercial model around. And then they Series A financed that. And what was great is I'm sure when they went into their Series A pitches, they didn't probably talk about their consulting revenue. They were probably just like, oh, we did the consulting thing to bootstrap. Right? But really the thing is this open source project that has this traction and the commercial model around it. And then people can like paint their own picture of what the potential is there. and they've raised like a pretty sizable Series A from good investors. So that would be like if you like study the history of that company, they also blog publicly a bit and you can like read about their history. That would be my like example for how a first-time founder, because Tristan is first time, I think he like worked at a startup before, but he's a first-time founder, how a first-time founder can like stretch out the bootstrapping period to get to a grade A without, having to, go into debt or something like that.
Yeah.
Right. So
it's like, I mean, there's a bunch of ways you can make quick money. I think the biggest risk is like losing focus, right? Like focus is so valuable. So it's really like, what are things that make money, but kind of are
still keep you focused on the problem somehow.
Yeah, that's the winning combination. I think there's a lot of variety of ways to do that, I think, but the consulting is a great one.
Yeah, I never really thought of it that way, but it's essentially somebody paying you to do future product research.
Yeah.
Exactly.
Yeah, and if you're smart, your product becomes like the upsell inside of your consulting company, and then now you have customers, and you never even had to like sell them the old-fashioned way. Kind of nice.
Oh yeah.
I got one more for you, Andrew, on that keeping the Series B small. What was the negotiation like with your Series A investors around that decision? Was it difficult, or did you have enough? Were your investors aligned enough with the business to make that an easy conversation?
There was a lot of discussion at the investor level about whether to do a huge Series B or not, right? And it wasn't so much that the Series A investors wanted to block the small Series B. No one really spoke in those terms about like trying to, control the way the financing round went. It was more like, it wasn't an obvious move to raise less, right? Because one of our top competitors in a niche that we worked in our market had raised 3 times as much as us. And so there was like a debate. This also actually is an interesting dynamic with investors, which is they pay very close attention to what your competitors have raised, because investors feel very strongly that every market is a winner take all market. This is kind of like one of the truisms that they kind of carry around, almost like a Bible quote, So they feel very, very strongly that, if your competitor has outfunded you 3-1 or 4-1, you're just going to lose, right? Because they think money solves all problems and all that stuff, right? And so in our case, we did have a competitor who had raised like 3 times as much as us, and we could have raised a Series B that would have had us raising like a lot more than they had raised in total, right? But instead we chose the other way, because we actually chose to like pivot the business a bit and go after a bigger market on the foundation of what we had so far. And so we just had to kind of explain that to the Series A investors, but like that, that it is true. You're raising a very good point, Peter, that like once you have investors, whether to fundraise, how much and from whom isn't just your decision anymore. You start to have that discussion even at a board level. Like you tell your board, we're going to go out and raise a B, and here's how long we think it's going to take. Who do you think we should meet with? Do you think it's a good idea? This is the valuation we're targeting. That becomes a board and investor level discussion rather than a founder discussion once you go beyond the A stage, basically. So, yeah.
I have a question. How helpful can investors be in terms of helping? So as an infrastructure product, my customers are kind of like, if you run infrastructure, cool. How helpful are they at kind of cross-selling to other companies potentially in their portfolio?
I'm going to give you a pithy answer on this, even though I'm recorded. But the pithy answer is that if your investor writes you a check without squeaming, without being squeamish about it, and the wired money hits your account, and then you never hear from them for 2 years after that, except that they check in 2 years to see how the company's doing, that's an A+ investor already, right? And if they come and offer some help, that gets them bonus points and A+. They offer too much help, it already docks them down to a B+. And the truth is that it's definitely the case that some investors are more helpful than others. Some will be very good at introducing you to people. Some of them make that very much their thing. that they want to be as helpful as possible. That's how they differentiate. But, you know, I hear way more stories about investors micromanaging, controlling, causing trouble, doing political weird moves, you know, whatever. And so actually, if they can be like a source of capital that just puts some trust in the founders, that already makes them an A+. And so that what I would basically say is, you know, you don't want to necessarily look for the person who looks like they would be the most helpful. You want to look for the person who, when you do the reference checks on the founders, you don't hear any complaints at all, right? Because if you hear even like one or two little complaints from founders, probably that's like a problematic investor that is going to cause you 10 times more problems than that down the road, right? So yeah, I would say don't expect too much in terms of soft stuff. Pretty much,
Yeah,
it's on you to make it.
Again, especially in those sort of smaller niche areas. So specifically, like my second startup was in the education space, and there you see more, you know, investors who want to help you make connections, not so much like sell you into something, but like people who like just having their name attached to your list of investors is kind of helpful. Like you know, someone everybody knows, and you can kind of name drop, and people are like, oh, okay, like, you know, you can jump the "are you just a total joker" bar very quickly by having like a big name. But yeah, but otherwise, other than that kind of like very specific strategic investor, I kind of agree with Andrew. It's like, you know, but people want to help, and they're usually trying to earnestly be helpful, but sometimes they rope you into some deal that doesn't quite make sense, and like the customer's not quite having it, but they're
not going to help on the biz dev side. They might help a little on the hiring side, especially for hiring executives, although you have to be a little careful about that because investors also place executives at companies, which is danger. But they can be helpful there. And then the other thing is they definitely are helpful for doing the intros to other investors in the future round. And this is where the Ponzi scheme aspect that I mentioned earlier comes up, right? Like a investor who's really excited about company A at Series A stage and who thinks the metrics justify an uptick in valuation at a 10x price will introduce you all day long to Series B investors. And the reason they'll do that is because if you get one of those investors, the Series A investor gets to write up their paper as being an uptick in value, right? Which is exactly what the whole game is about. So like, that is something they actually are good at, and like they will open up doors into future rounds. And you know, you're not a smart founder if you don't ask your investors for intros to other investors. That's pretty much the number one useful thing they can do for you. But and by the way, you do have to ask them though, because they're so busy that they sometimes forget to give their founders intros to obvious next stage investors and stuff, right? So you kind of have to like sit down with them and like say, okay, who do you know at the B stage who likes SaaS companies? Like really rack your brain, have your assistant go through your LinkedIn, you know, that whole thing, right? But yeah, that's the one really valuable area, but everything else tends to be a little lower value.
All right. Any final remarks? Thank you guys so much for your time, and I think everyone would agree this has been time very well spent. Some very interesting stories and some good little nuggets. So one of the ways that we say thank you at Penny University is whenever we have a good experience, we take a moment to jot down a little bit about what we learned. I encourage you guys to do it. It's not a rule; you don't have to, but it's kind of a way of saying thank you. We listened and we appreciate your time. So. Andrew, I'd love to catch up at some point eventually. Michael, we talk all too much.
We need to play a game of Go is what we need to do. Too much talk, not enough.
Not enough Go.
Board battle.
It's coming soon. We got that lightning talk. I'm going to teach everyone how to play Go.
Nice.
All right. Well, I'll see you guys around.
Thanks, everyone.
Thanks, everyone. See ya.
Thanks, guys.
Thanks all.
Good to talk to you.